Good morning, everybody. Welcome to the Flow Show, Friday, 12th of January, the day after the night before and all that CPI data that moved markets. Hope you've all had a good week so far. One more day to go, and then you can all relax for the weekend. Welcome back to K-Man. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, I'm doing all right. I see that you left most of the markets unchanged compared to where I left them, where I ended my early week on Monday.
Yeah, plenty of movement in between, though, I can tell you.
Yeah, that's true. But yeah, I mean, coming back, I only see dollar yen is fractionally higher, but literally the rest is around where I left it.
Yeah, pretty much. We've still got some higher vol in the dollar yen more than the others. Just looking at the vols yesterday, 1 month at the money vols, euro, dollar, and cable trading around 6%, 6.3%, euro, dollar, 7% for cable, dollar yen, 9.3%. So yeah, there's a lot more volatility in dollar yen at the moment than other pairs, hence why it's moving around a bit more than those other pairs. But we shall take a look at the prices in more detail shortly. I'm sure you've got some upgraded rainbow patterns for us to look at since you've been away. I might liken your charts to that one on the weather I posted in the room earlier.
Oh man, in Belgium it was -7, -8 Celsius at one stage.
Oh, blimey. Snow or just cold?
Freezing.
Yeah, no snow though.
No, we didn't have any snow, no.
No, that's a warning for us here in the UK next week. Potentially significant snow, which if we get mild snow, it brings the country to a halt. So significant snow, you're probably not going to hear from us for about 2 weeks, perhaps next week. So keep that in your diaries. If you don't hear from me and K-Man, we're probably in burning furniture or something to stay warm. But we'll keep you updated on the weather anyway. Right, let's get stuck into it. I'm going to kick off with the Chinese data from overnight, CPI data, PPI data, coming in soft as expected, not as negative as expected. CPI minus 0.3% year on year was expected at minus 0.4%. Not that it matters too much. That's now 3 months of negative CPI numbers. PPI as well, a bigger negative than expected year on year. So they are potentially in the grip of a little deflationary spiral going on in there. You could probably still call it disinflationary, but well, I don't know. I think they're heading to a bit of a deflationary period. On the trade front, though, there was a bit of improvement. As you can see, their trade balance improving, a pickup in activity in exports. 2.3% beating expectations there, bigger rise over what was seen last month. Imports as well into the positive, though missing expectations. So bit of better on the activity front. But like I've been saying for the latter part of last year, I don't think they are out the woods just yet over there in China. On Monday, we do have the latest MLF rate decision. Market expecting rates to come down by 10 pips. I think the risk is that maybe they go a bit more than expected, but this is just one of the smaller rates, shall we say, that they use over there in China, not like the big RRR reserve requirement ratio rate that can be cut and may possibly be cut, but they may embark on another round of rate cutting anyway. After that trade data, China officials said that the favourable conditions for trade outweigh the unfavourable ones. And I guess we'll get to see whether that bears fruit. The PBOC fixed the yuan again in the 710.50. So around about the same level they have been for a while. This is all while the exchange rate is still floating around up at 717, 718s. So they're keeping the pressure on there not to let the rate get too far away, not to let people get too far carried away in weakening the yuan over there. But they're keeping those fixes very, very low. Over in Japan, a record surplus for November on the current account. or record current accounts surplus for November. Was down on last month and missed expectations, but it apparently, as I say, still a record number there for them. Is this something we need to keep an eye on? Is this going to factor into BOJ thinking? Or, is it just
indirectly, not directly. I don't think that the Bank of Japan reacts on current account, but for the currency, positive current account is always better than the opposite. We've seen that for the better part of the pandemic, and when others were hiking rates, and that had a bit of an effect as well on the yen, that it has been in negative territory. But it came out of it. It was irregular for a good part of last year, I think. But towards the end of the year, started to print more regular numbers into. Okay, since April it's been positive then, but it had a very irregular pattern over the period before. It's always better for a currency when your current account is in positive. That's a fact. And then you have to see how that translates over the trade balance, whether it's driven by the positive trade balance, or driven by other factors. But it's always better when it's in positive territory.
Do you think this is one of the things that's being supportive of the Nikkei as well?
Well, it can be if it is foreign inflows into their markets. It can be that it's a positive driver for the Nikkei. I've seen not specifically over the last couple of days when I was off, but I've still seen people being quite positive on the Nikkei, despite those expectations that the Bank of Japan is going to normalize. So that's what we were that was I was looking at, and what I was saying in this morning's in the chat room as well. Is this Nikkei move something that people are a bit behind the curve and want to invest more in the Nikkei, thinking that the Bank of Japan is going to be too slow to really impact a lot of on stock markets, or is it in turn a testimony of how shall I say, being positive towards the Japanese banks and stuff, especially the regional banks, who are going to likely make more profit when the rates are slightly positive than where they are now in negative territory. We already had a few hints there with some of the yields coming up that the banking system was doing better as well. So it remains to be seen once the Bank of Japan starts to normalize, but positive current accounts are usually relatively positive. Well, the thing is, the opposite is more damaging than this. Let's put it that way, if you get what I mean.
Yeah, it all helps. It all goes into the mixing pot of positivity, and it's right. You know, one of the reasons why Nikkei's getting such a good boost is because of Japan coming out of its easing cycle, rates going up, which means banks should be more profitable. You know, and it's a pick me up for the economy as a whole. It should be, you know, which is positive for stocks in general when you're coming out of a big deflationary, low growth environment to potentially something that's better. Yeah, so it should be that's how stocks should work. It should be a boom for stocks in that economic scenario. But we'll wait and see what happens when they pull the trigger, if they pull the trigger in the spring. You can tell there's a bank. Yeah, sorry, mate.
Yeah, just replying to Chris. No, we were talking about the current account, but both could be a little bit linked with some delay. The current account will probably show it later than the weekly foreign and Japanese bond and stock buying. Those numbers are relatively how should I say, they are quite volatile, those numbers, but I trust that foreign buying in Japanese stocks has been positive as a whole over the past months or so. Especially, you know, it's been going on for a year and a half, right? Since Buffett has said that he was very positive towards the Japanese, what is it? Not the trust funds, but some other guys. Yeah, the trading firms, right? It's been starting really from there, and now the market is really taking it on. But having a positive current account always helps.
Yeah, exactly. I don't know why those numbers on these are showing the same thing: foreign bonds buying with different numbers.
Because the one is,
one is
yeah, the
domestic
one
and one
are,
is
the one are,
one of these. One of these should be Japan for
yeah, that's a
Japan
wrong.
investments, domestic. Let me see what one's what. 542. So that is Japan buying of foreign bonds. This
Yeah,
one 542, and this one is where is it?
the minus 204.
I'll tell you what. Let me put it up there. That'll make it easier.
I don't
So
even know.
those are the numbers there. So it's the calendar that's just written them both as foreign bonds,
Yeah.
where one is foreign buying and one is Japanese buying. But there you go, foreign buying of Japanese stocks up 296 billion versus a drop last month. So you can see that people have already been piling in to the stocks anyway. But yeah, just that calendar, investing calendar is just printed foreign for all the components. So ignore that. But anyway, right, moving on. As I was going to say, yeah, it's obviously a Bank of Japan meeting next week because we're getting all the sources droppings. Yesterday, we had Gigi News saying that the BOJ would consider lowering its price outlook for the fiscal year 2024 to the middle of the 2% range. Their current range or their current forecast for that year is at 2.8%. Again, I will just show you those forecasts there. So this is what we're talking about here. The range 2.7, 3.1, company at 2.8 as a median. So GG is reporting that they may bring that down to the mid 2%, so call it 2.5. So bringing their inflation forecast down, which is not hawkish in the slightest, but the yen surprisingly didn't move on that headline. But as I say, we're getting sources plenty at the moment. Follow up to that, Bloomberg looked like they were half rehashing that story by saying that sources are considering lowering forecasts for growth and inflation. And then this morning, a Reuters piece said that the BOJ would stick to their forecasts of inflation staying near target, according to sources. So everyone's playing the sources game ahead of the Bank of Japan next week. Announcement on the 18th, I believe, if I'm correct. And yeah, there's little expectation for any major action. We've still got the potential question around YCC, whether they'll do something with that or indicate that they're going to widen it really wide or scrap it altogether or whatever. Other than that, I don't think there's much expectation. So the forecasts are probably going to be the most market moving if there's any big wholesale changes there. And all eyes will be on what happens in 2023 and 2024 and potentially what they do with 2025 forecasts. An ideal scenario for those hawkish on the BOJ would be these forecasts all moving up when we get these forecasts at this meeting next week. You got any expectations for next week, mate?
Well, I just put it in the chat room. Base case is nothing right now, and they've already told us so many times that they were waiting for the wages to come through. But looking at what's happening in the JGB market and what locals have already been doing and gone to auctions and stuff, although the last one wasn't brilliant, but still. There is actually no reason for the time being to keep YCC there. But are they afraid of the market expecting too much if they let it go right now? That's a possibility, but there is absolutely no reason to keep YCC, though that is the element of possible surprise that we have in next week's meeting. Besides the fact that all the rest should be unchanged, and my base case is still unchanged, but again, continuing to adapt the wording to prepare the markets for the change to come once come the end of the fiscal year, right?
Yeah, exactly.
That is really the base case is no, nothing is going to happen. But the surprise element could be that they saw enough. They're happy with everything, and that they are effectively abandoning the YCC, which will then come as a surprise, and then probably send the yen 2-3% higher in the sessions afterwards, and then we will see again where if it holds the bid or not.
Yeah, yeah, and I think maybe the other thing to watch out for next week, and obviously we'll talk about this in more detail next week, is whether UEDA decides to drop another little hint. The last few meetings, he's dropped in more positive reasons why they're going to exit. It's the creepy, slowly catchy monkey thing, where just he keeps dropping these little hints in and these little comments in to prepare the market for the possibility. So he may add a bit more to what he said in prior meetings as well. So
yeah, but that's exactly what I fully expect, is to continue this rhetoric to the statements to be adapted to prepare the market. That's really the base case. But that in turn, if it's only like in the words and we will this and we will do that, that's only going to provide, I think, a temporary move in the end. What's going on right now is more like what happens on the other side of yen pairs, right?
Yeah. So right now, as we sit here today, there's pretty low expectations, but don't be surprised if you see some last minute trading around the yen, with some maybe hoping that they're going to drop something quite strong. We've seen it going into these meetings now for several months. A little bit of hawkish expectation creeps into the market. So be prepared for a bit of that. Could see yen strengthening on that side of things and then getting blown out of the water after the meeting. For me, I'm out all my dollar yen shorts. I took a bit of a hit on the balance. Got out 146 in the 146.20s yesterday on that break. It was just pushing too much for me, and sitting there bleeding away the money I already made. So I've taken some profit out of it, but given a hefty chunk back on the balance and the costs and whatnot. But yeah, I still favour it, but it's a timing issue, and you have to be nimble and you have to make some money quickly on the positions you've got if you're short yen pairs, and trying to run it for a bit longer than normal. So I'm flat on that, and I'll be looking to re-add as and when I feel the timing is right. Right, moving on. Riksbank's Bunye says don't expect further rate increases. So ruling that out from the Riksbank. Over in the UK, we had some GDP data. As I've been mentioning this week, I expected that it could come in stronger than thought, and it did by a pip. Woo! A whole pip higher than expected, 0.3% versus 0.2%. This is just a monthly number, year on year coming in as expected. However, the 3-month rolling number, if I can find it, where is it? It's all over the place. There we go. Came in a bit softer, but that's reflecting more the last couple of months, because obviously it's a 3-month rolling number. So minus 0.2%. Again, I would expect this to improve a bit more when we get the December numbers, if the December numbers follow the November numbers in being positive, so that might creep up a bit. But obviously then we'll be getting the Q4 data anyway. But anyway, that positivity in November showing in the GDP there. Other numbers, construction looking a bit soggy, coming through into the winter period. It can get a bit seasonal here. Manufacturing and industrial production, no real shocks there. Positive numbers, hitting expectations, just beating expectations in manufacturing. The year-on-year numbers not as sucky as expected, worse than expected on that one, and up on last month, but not as great as expected for that. Trade balance, as you can see, they're just improving as well. We did get some final CPI numbers from Europe, France and Spain. Not much to write home about there, all coming in round about the flash numbers. So nothing to bother us there. On the central bank front, ECB's Wojcik said that 50 pip moves are not to be excluded once ECB rate cuts start. But at the moment, is not too concerned by market pricing of rate cuts. So no real pushback then. You could take that as a bit of a dovish slant, probably just not ruling out any options. ECB's Lagarde was out saying we are winning a battle at the moment, speaking on French TV, but says we must complete the job. She says we think we have passed the hardest and worst bit regarding inflation. There's a kiss of death for you. Thinks we're at peak rates unless there's a shock. And she can't give a timing for rate cuts, and that rate cuts can start once the data confirms the inflation path. Obviously, downward, not upward, as we got in the last numbers. US CPI yesterday. Pretty hot numbers in the end. CPI jumping more than expected to 3.4%, so 2 pips higher than expected, and the core not coming down as much as expected. So definite higher for longer numbers there. Bit of a wild reaction in markets, really. Bonds yields, US yields didn't really take off. They nudged higher, but didn't break prior highs. Stick that on the chart for you. So that was the move on the CPI data, a move up into 4%, but couldn't really build on that. Dollar yen went running all the way up to 146s, through 146s, near to 146.50. And there was a lot of ping pong. It was up and down and up and down and up and down all through that period, really. But here we are again with us down around the 145 mark. So the market really wanting to keep selling dollars at the moment, even with data like that inflation data, which could be construed, which is hawkish for the Fed, at least for the higher for longer message. And we've had several Fed members coming out since saying that the job's not done, and I'll touch on those in a moment. Also in the numbers was real average earnings, which I don't think are on this calendar. Are they? Nope. So I'll have to tell you what those are. So average hourly earnings year on year came in at 0.8% versus 0.9% prior, so a pip softer. Same for real average weekly earnings year on year, 0.5% versus 0.6% previously. So a bit of softening in that wage data. You'll remember in the NFP we saw wages coming in stronger. At 4.1% was expected to fall to 3.9%. All that data got the market erasing some thoughts about March rate cuts after that data, but you wouldn't think of that this morning given the level of yields and the dollar. The market isn't dropping the bone whatsoever. So we had some Fed members out. Fed's Mester saying that the CPI numbers show the job isn't done yet, and says she forecasts inflation will continue to fall this year, but won't get to the 2% target this year. Says that incoming data has been consistent with a soft landing, sees March as too early for a rate cut and needs to see more evidence. Says we will have a conversation on rate cuts as we see continuing disinflation, and that this year will be the start to having conversations on the balance sheet. Fed's Barkin said we need to be convinced inflation is stabilising. Would not be surprised if it takes some time for inflation expectations to converge back to the Fed's 2% target. Also, would not be surprised if core PCE remains in a range consistent with target as it has over the last 6 months. That's the Fed's current expectations for it. Fed's Goolsby says doesn't want to commit on policy decisions when the Fed still has weeks and months of data to come. The Fed can't answer the question of what it is going to do at the March meeting without seeing the data. Bit of a can kick there. I don't know if you got any comments on the CPI numbers, Kay, or the squawkers, but sticky.
Yeah, exactly. And is it not the same that what we've seen in on the European side that came out before? It's all a bit sticky in this in that end of year, right? So perhaps we need to, as the central bankers really say, and as we have been saying so many times, really need to see it several months in a row, and then see what really happens in 2024 to make a decision for 2024, or at least to sharpen our expectations for when timing may be. What I did find though, which is also a bit logic, if when you come to an end of the cycle of this hiking cycle, which is probably ended now, we can call it that way, barring really big surprises. I found Mester a little less hawkish than what she usually is, but then I did not hear the interview live. I was just reading the headlines. Yeah, the rest of the guys just pushing back against some of the expectations, but not really. They're just there in a wait and see mode right now. But the only one I thought was just a little bit Mester, because she usually was still pretty hawkish, like she's the American Schnabel, right? So yeah, I thought that was perhaps a little less hawkish there. No, for the rest, yeah, I think it's a bit similar as we saw in Euroland, and the result of it is that we are sort of back where we were prior to to the US CPI as well. FX seems to be the one that is really definitely in wait and see mode, where the rest of the instruments move around on more geopolitics and expectations. Also, we have earnings, so we see the stock markets move. We see oil move on the back of geopolitics. We see other stuff move on geopolitics, but FX seems to be the one that is now in wait and see mode, and without overly big flows coming through. So we are going to need to see a move away from the path of inflation. I think if you want to move back, if you want to see moves on the back of inflation, and so that brings us back to what I've been saying for a while, is going to be a case of the difference in growth will start to play a bigger role again if inflation goes the same way, basically across the pond, right?
Yeah, yeah, very much so. And the US is obviously going to be 2 times more important than what everyone else does. But yeah,
Absolutely.
that's been the case. That's been the case.
Yeah, because the US is just the bigger market,
Yeah,
and that's where the most money is flying around, right? So that's always going to be the case. You first look at the US markets, and then you compare the rest of the markets with it. That's true. Yeah, yeah.
yeah. And as I mentioned yesterday, it's also the divergence in rates when you're looking particularly between the US and Europe. US has that much higher rate, so there's a bit more emphasis on getting that down, whereas the ECB may have a bit more time to see how things going before they need to look at cuts. But even though the Eurozone economy may be looking a bit worse than the US, it's that rate divergence that just gives them a bit of wriggle room, shall we say. On the bond front, we had the 30-year auction. So that ends this week's of auctions from the US and elsewhere. Pretty decent auction in the end. There was a lower on the bid to cover ratio, which could be construed as a bit of a negative. But as Mark said in our chat room, the fact that we all got filled, you'll take that given the amount of supply that's come to the market this week. So yeah, even though it was a little bit soft, that's not going to derail anything, and it's been a successful week for
Yeah,
the
the,
auctions
the,
so
the
far.
indirect take-up is I think what people are looking at right now, to know whether it's a success or not, and that's been on the better side. I think I haven't looked at the other ones, but it does look like the foreigners, at least if you talk about the belly and the longer end, they are going to auction. So that's a bit of a
Yeah,
positive there. And if I just may, back on those commentators that we had post CPI, what I've been mentioning before I left and already the week before is that the market is starting to look at what's happening in the reverse repo market, and it looks as if Mester was commenting just like the one-liner about it, that they need to talk about the balance sheet this year, and that actually may be a bit of a bigger thing than if the balance sheet roll-off would continue to just buzz in the background without having to change anything because of still the ample reserves in there, it wouldn't mean so much. But now the fact that they are starting to talk about it may drag the market's attention a bit more towards the balance sheet as well, because the RRP reserves are coming down. As I said, they are not yet at alarming levels, but they are starting to reach slowly those levels. So, and that people may think that would perhaps push the Fed at cutting back on the balance sheet roll off a bit faster than what they were saying themselves until the December meeting, actually, Powell. But Powell in the December meeting was a little bit vague on his response to that. So that is something that we will have to pay attention to how the Fed members communicate about that one.
Yeah, very much so. We're starting to get some earnings dropping. We've had United Health dropping with better EPS and revenues. BlackRock's dropping as well. Better adjusted EPS. It looks like inflows were below estimations, but their AUM rose to 10.01 trillion, beating estimates of 9.78 trillion. So first of the big financials coming out and looking okay so far. We get bank earnings, a lot of bank earnings dropping today as well. So keep an eye on those for stock trading. Right, that's kicked me out of my train of thought. Just some other bits and pieces really on the geopolitical front and whatnot. We obviously know that we've got these allied strikes in Yemen, a bit of a punch back against the attacks that have been going on there. That was authorised overnight, and those strikes had in play overnight. Obviously, seen oil keeping a bit of a bid on that, although it's not. This thing is not yet dragging in any of the big oil producing countries or getting them really involved. So it's still a little bit of a bubble. Oil's bid, but it's not rocketing higher on anything too much at the moment, though that can change pretty quickly, as we know. Some inflation for the US. Tesla apparently notified all its US production staff that they will receive a pay increase. That's coming, and again, something I looked at yesterday. All those UAW, United Auto Workers Union strikes last year, a lot of those pay agreements kicked in January, beginning of January. So that may bring some inflationary wage pressure to the next numbers we get from the US inflation. So next month, when we get January's numbers, we could see a bit of an inflation input from those wage hikes as well. But it's not all going tickety-boo. Amazon, I reported yesterday, they were looking to cut staff in their Prime Video workforce. Now they looks like they're going to be cutting 5% of jobs in their Audible division as well. So, yeah, starting to see a few more job cuts creeping up. The Bitcoin ETFs all got launched and all started trading yesterday, and I've started to put those into a watch list. Don't ask me why, but where was it? That's what I started to do. So there's all those ETFs there. A bit of a familiar story across them, where they all opened, shot up higher, and then all dipped back to near where they opened. So this is probably going to be a long-term process that those who've got interest in it need to keep an eye on to see if the money does come flooding in over the next few weeks and months. ARK's Cathy Wood, talking her book and a new ETF, says that she sees the price of Bitcoin reaching 1.5 million by 2030 under a bullish case. 1.5 million for Bitcoin. Tell you what, Okay, we might have to up our bids from 30, 31 bucks to 33, 34 bucks, mate.
Yeah, I think so, mate. Massive hike there. My bid, I'm thinking to go to 32 from 30.
Yeah, maybe put a buy stop in at 1 million. So catch the last 500,000 on that one. But anyway, so yeah, Cathy Wood's being all bullish, obviously, talking up her ETF as well, no doubt. Right, let's get stuck into things today. It's like deja vu at the moment in a lot of these pairs. As we mentioned yesterday, watch out for similar moves that we got over NFP, and we got similar moves over the inflation data. We went up, we went down, and then we're back in the middle. That's why I said yesterday, don't get caught up in any of these moves. Let's see where things settle, where we close. Even dollar yen, massive break through 146. Thought we might be off to the races, and boom, here we are knocking around the 145s the next day. So you can't really trust any of these moves we're getting at the moment. It's okay if you want to try and play the range, but you've got to be wary of these excessive moves out, particularly for dollar yen. As I said, there's a bit more volatility here than there is in other pairs. But for the rest, we're not going anywhere new, even after that data. And I'd expect potentially even similar to less of a move on the PPI today. We're not ready to move anywhere new. So the market is still in wait and see mode as to what central banks are actually going to do and how the data is going to progress. Dollar CAD, another one, had a little decent mooch through 134, but we can't hold above there. And now we're back below and swimming in the same waters we have been for the last week or so. Ali, you're still in your euro sterling short, I see. Hope you've got enough coffee on the boil, mate, because I hope you do get your TP. But as I said yesterday, it might be a long old wait for you to get that. Oil, as mentioned, yeah, it's ticking up. But look at UK oil; it's now in the 80 buck mark, so it's having a little bit of an extra run up on there. I did see a headline that a man is getting all bullshit about all this sort of stuff. So maybe we are going to start to see an escalation. Iran taking a stronger hand in all this than what they are already by their proxies and the Houthis and whatnot. So it's one to keep an eye on. That's obviously going to influence CAD to a certain extent when you measure risk and what's happening in oil. So no surprise to see dollar CAD a bit lower as well as that. But the dollar generally just a bit softer today, even while stocks are doing fairly well. As we can see, US not so good, but Europe is doing fairly well at the moment. So that perhaps indicates a bit of a risk off US style, if you know what I mean, with the US getting involved over there as well. But I did fancy a dip yesterday. I didn't get in this one. I was going to look to maybe see if we could get a move down low in the 47s because I fancy buying a bit of a dip in this one because I've got a feeling that these bank reports are going to be fairly okay. I'm a bit worried to see whether we get any worries about bad loans and whatever. But I don't know. It's a bit of a gut feeling. So, not built on anything really solid, but I've got a feeling we're going to be blowing out these 4,800 highs. Maybe I was just a bit too greedy looking for a dip in that yesterday, but we shall see what happens with those reportings today. Kay, you got any updates you want to show us on your charts?
Very little. Well, I'm just going to reply to Ali. I'm also just a tad short euro sterling, just because of sterling doing a little, still looking a bit positive. But I was actually thinking this morning. I said, well, with his involvement in against the Houthis, also is it perhaps a bit risky to stay long sterling? But the cross doesn't seem to move. I've got the impression that somebody is having something around 86, the figure, and they're just trading around. It's 86.20, 85.80, and that's typical for if people are short volatility or so around the big figure. Then you're gonna find sellers above sellers around 20 and buyers around 80, and that looks what is at play right now. We need to break out of this 85, 80, 80, 86, 20 zone to start moving again.
Yeah.
That's my feeling on that one. In the meantime, okay, for as long as it's not ramping higher, I'm going to keep it. I'm short around that 20 zone, so
Yeah.
it's like it's going to be a very, very low risk trade. Yeah, on gold, while you're on there, it's probably due to the conflicts now as well, right? Because the interest rates are moving just inside a range. I've got that level around just those low 20, call it 2050, 52-ish. If that would go higher again on gold, then I guess we will have a chance to have a revisit of that peak that we saw there just early January in the 2060s. But it's going to take a break above that 75 and then 85 to really continue to go. So for that time, if you look at it, we're still pretty much, barring some spikes here and there, we're still pretty much in a range on gold, right?
Yeah.
Yeah, that 2009, low 20s, that's probably going to be decision time on the downside. And silver is pretty much the same, turning around at 23 bucks, pretty much in a range right now. And just looking at the clock, but I've got very little to show, what I was
Yeah,
looking.
well, I can keep it. Isn't it? I was going to have a
Yeah,
quick
keep
look
it.
at.
Just go on the yen. Go on the yen.
Yeah, which one do you want? Anyone or
The
just
dollar
dollar yen?
yen. Just the dollar yen. Because there's a little bit. You've got that 144.70, and then I've got the some stuff in the 144.5s as well, which is I think 38.2 or so of the latest move higher. For as long as that holds, there's a bit of confluence around 44.5 for me. Yeah, it doesn't really show there. Oh, it's perhaps of the move lower. Anyway, I mean, I've got some stuff around 144.5, and if that holds, then we are in a bit of a step formation still for the dollar to at least get a test back of perhaps that 146, 145.70, 146 zone. But I don't expect too much of waves when I look around the whole spectrum. As I said, I mean, euro dollar is 15 points away from where I left it. Cable is also 10 pips away from where I left it. Aussie and Kiwi are actually exactly where I left them on Monday. So I don't think. Well, you never know. Never say never, of course. But PPI, if it's in line with what we see across the rest of the world, they're expecting some positive print, but I wouldn't even be surprised if it comes out flat or so, totally flat, because the rest of the world is slowing down a bit on the PPI still. So I wouldn't. Yeah. So we could undershoot a couple of tenths of percentage there. That's a bit of a risk for this afternoon. But will the dollar market really pay attention to it? I'm not even sure. For more than the spikes, as you have experienced over the week, you see nervous spikes, rapid spikes, and then when the dust settles, we're back to in the middle. Yeah.
Yeah, and PPI is a bit more of a volatile number, so you can get bigger variations in the PPI data, and I think it's going to need a big variation number to sort of match what we saw in the CPI numbers. If core PPI comes in anywhere between, I don't know, 1.7 and 2.2, that's there or thereabouts. If you start seeing, 2.8, 2.9, 3%, then that's a different kettle of fish. And same on the other side, if it's down at 1%. Or even a negative, that might bring a bigger move. So it's a case of ratios that PPI needs to do a bit more, or can do a bit more in the numbers than we see from CPI. Most definitely. Dollar Mex is one I'm just keeping an eye on. I've still got some bids in this one, down into those lows, but we've moved off that area up here. I could probably maybe widen that band a bit to incorporate those highs as well, but we couldn't get through. We couldn't hold through, so maybe we're going to get another move down towards that support area down here in the 16, 69, 70, 71 area. Gavin had his level down there, which was very nice previously. That will be the first area of interest should we get there. Any comments on this one at the moment, Kay?
Yeah, I mean, isn't it a little bit the opposite currency of the yen right now? Of course, yen has other stuff going on, but it is very comparable at the opposite side of the interest rate spectrum, right? The Banxico has not yet fully acknowledged the pivot. And then we see spikes perhaps on a bit of risk off and things happening in the dollar mex. The long-term move is done, right? I mean, the move that we had post-pandemic on the back of carry, massive carry and stuff, I reckon it's done. But we are at the opposite problem for the mex than we have with the yen. How long can you sustain to be short Mexican peso if you pay away 11% funding a day, compared to, at best, you get in the dollars 4% or in sterling perhaps then 5% or so, but even then, I mean, you're not getting as much. It's the opposite issue than in the end. I'm still a little bit. It's really a little bit short Euro Mex, and I'm getting paid for it every day. That is something that we have to take into account if you counter trade the MEX. It's as if it's when you counter trade the yen. Again, with different sensitiveness or something, and but it's still a bit the opposite issue there. Especially that what I did see though is that Mexico overtook China as the biggest exporter to the US in 2020. Apparently at the end of 2023. So that should in turn keep the positive vibes a bit longer, perhaps, in the Mexican peso. But that is one to keep an eye on for when Banxico will turn. I mean, if Banxico turns, then that thing I think is going to see getting hit pretty hard. Or if people, as people were saying in the market, or if Trump gets re-elected, but that's music for much later in the year. But if that starts to filter through, that he's there and has a chance to get through, then you have to be careful with the Mexican peso, because then it could really lose several percentage points very, very quickly.
Yeah, and then we'll get a lot of the carry traders turning, but they've got a lot of margin in the trade. You know, looking at that, the last bounce didn't even get up to the 38.2, so no one's going to be panicking until probably 19 starts breaking. But you may get some of the late comers down here.
I mean, it's not while we're moving even to those spikes there in September. You know, on the scare. Oh well, that's on that scare when the Banxico said that they were stopping their FX program or halving it, whatever. We had this big spike. I think that's your panic level, probably that 1850.
Yeah, definitely. But it's still for me, it's still working out this downtrend. So that downtrend is still in play. So I'm still happy to maybe try a bid down here. What I'd like to see is a first test come down here, and then I'd like to try and capitalize on any bounce. But I'll be watching this level. If it doesn't get above there again, it would keep the downtrend going. So another move back down here would potentially spell trouble. So I'm just looking to take a quick few bucks off of the bounce in that one, should it happen, and if I like the move. But anyway, that's that. We've gone on long enough today, and it's Friday. I'll let you all, boys and girls, all get back to your charts, try and squeeze out the last beer pips of the week. Trade well, be safe. Thank you very much for coming to the Flow Show. Welcome back to Mr. Keyman, and we're back to full strength, although it's a US holiday on Monday. Stocks are closed and everything else closes early, so it might be a bit of a quiet one to get us started for the week. Until then, have a great weekend, everybody. Thanks for coming. We'll see you all on Monday.
Thank you. Have a good weekend. Thanks, Ryan.